Last year, right, there was this digital coin named after a literal internet dog meme, and it generated more web traffic than the GDP of several small countries.
Oh, it was absolutely everywhere. You couldn't escape it.
Everywhere. And then within about a month, it basically just vanished into thin air.
Completely disappeared from the serious conversation.
Right. But meanwhile, on that exact same day, you have other digital networks quietly processing billions of dollars.
Real global transactions.
Exactly. No billboards, no celebrity endorsements, no viral hashtags, just quietly doing the work.
Which really highlights the ultimate paradox of this space, if you think about it.
How so?
Well, the loudest projects are often the most fragile, right? While the quietest ones are actively running the plumbing of the new digital economy.
That is such a great way to put it. Welcome, everyone, to this deep dive in our Crypto Beyond the Hype series. Today, we are pulling from a massive stack of recent market analyses, developer white papers, and historical price charts to figure out a very specific dynamic.
The real core of the issue.
Exactly. We are asking, why do everyday people and massive institutions treat certain digital assets with absolute seriousness while treating others like, well, passing jokes?
It is basically the defining question if you were trying to look past the noise.
To make sense of it, I want you to think about your own neighborhood. You probably have a local Kirana store or maybe a corner tea stall that has been brewing the exact same chai for what, 2 decades?
Oh, absolutely. Everyone has a place like that.
Right. You walk in, you know the owner, you know exactly what you were going to get. Now imagine a flashy pop-up stall suddenly appears right across the street.
With the neon signs and everything.
Neon signs, a massive line, influencers taking photos, but it literally opened yesterday.
Yeah.
Now you might grab a snack there for the novelty, but if you are buying your monthly groceries or planning something that actually matters to your family, you are going to the shop that has been there for 20 years.
Because you know it's not going anywhere.
Exactly. We apply this exact same human logic to the digital world. This deep dive is not just a story about cryptography or, computer code. It is fundamentally a story about how we as humans measure credibility.
You see, when you look at the white papers and the historical data we're analyzing today, the surface level question everyday users ask is usually, will this asset appreciate in value?
Right, the classic number go up mentality.
Exactly. But the deeper structural question the market is actually pricing in over the long term is, can this system survive?
Survival over profits?
Yes. Market conviction is what bridges the gap between a temporary trend and a lasting digital institution.
Okay, let's unpack this, because the word trust gets thrown around in marketing brochures like just another buzzword.
Oh, all the time.
So before we look deeper at the data, we need to redefine what network credibility actually means when everything is decentralized. Because it clearly doesn't mean a money-back guarantee, right?
Not at all. I mean, in a decentralized environment, there is no customer service desk to call if things go wrong.
Nobody is going to refund your transaction.
Exactly. Credibility here is really a measure of resilience. It is a combination of durability, active purpose, and operational staying power.
Staying power.
Yeah. When we look at the analytics of networks that have survived for a decade, credibility simply means the market fundamentally believes the protocol will keep functioning. It will keep executing transactions and producing blocks regardless of external chaos.
So we have to completely decouple popularity from reliability.
Is that right?
A project can be trending #1 on social media and still have zero fundamental credibility.
The data shows us exactly that. Hype relies on constant new attention to survive. It needs to be fed. Credibility, on the other hand, relies on boring consistency.
Boring is good.
Boring is great in infrastructure. You can look at the on-chain metrics for certain projects. They are making headlines. Their price might not move much for months, but their transaction volume and developer activity show deep, foundational reliance.
It's like the difference between a viral internet kitchen gadget and your heavy, reliable kitchen knife.
Oh, I like that.
Right. You see a plastic gadget online that chops 10 vegetables in 1 second. It gets 50 million views. It is pure hype.
And it breaks after 2 uses.
Exactly. But the heavy steel knife sitting in your drawer, that doesn't need a viral video. It just does the work every single day.
And you can't manufacture that reliability in a lab. It has an active ingredient you simply cannot fake, which is the passage of time.
Time.
Yes. If you want to understand how a digital network earns that market conviction, you have to look at the absolute foundation. Time is the ultimate stress test.
Well, looking at the historical charts we gathered for this deep dive, you see these massive drawdowns. I mean, periods where the entire market just collapses by 70 or 80%.
The notorious crypto winters.
Yeah, the winters.
Yeah.
But wait, couldn't a coin just exist for a long time simply because it is, like, a zombie chain?
What do you mean by zombie chain?
Like a digital ghost town.
Yeah.
The servers are technically still running in a basement somewhere. The blockchain is producing blocks, but nobody's actually using it.
Right.
How does merely sitting there and ticking away build any sort of credibility?
That is a very crucial distinction to make. It is not just about the clock ticking in the background. It is about surviving extreme pressure while maintaining an active ecosystem.
Active being the key word.
Yes. A zombie chain hasn't survived pressure. It has just been forgotten by the market. True resilience is tested during events like algorithmic forks, major network upgrades, or massive liquidity crunches.
Like when a huge exchange goes under.
Exactly. When a major exchange collapses or a regulatory ban hits a specific region, does the network hash rate, which is the actual computing power securing the system, does it stay stable?
Right.
Do the miners or validators capitulate and turn off their machines, or do they keep verifying transactions despite the panic?
So it is active survival. The system takes a heavy hit, the price tanks, the news cycle is universally negative, but the underlying plumbing just refuses to break.
Precisely. And a brand new protocol, no matter how elegant its mathematical design seems in a PDF white paper, simply hasn't faced a winter yet.
You can't simulate a winter.
You really can't simulate a global financial panic in a testing environment.
That brings up a great question, though. Why would people stick around during a panic in the first place?
Right.
Which points directly to the protocol's purpose. If a network doesn't have a clear identity, there's really nothing anchoring the users when things get rough.
Purpose is the ultimate filter.
Yeah.
What's fascinating here is, when you look at the landscape of thousands of digital assets, the ones that retain capital over the long term, answer a very simple question.
Which is?
What is this actually trying to do? Is this meant to be a borderless medium of exchange? Is it a foundational layer for deploying smart contracts? Or is it an oracle network pulling real-world data onto the blockchain?
Basically, if you can't explain its job in one simple sentence, it is probably just a speculative vehicle.
Absolutely. If the only purpose is to generate yield or, wait for the next person to buy it at a higher price.
The greater fool theory.
Exactly. That ecosystem will evaporate the moment liquidity dries up. A clear, functional purpose gives developers a reason to keep writing code, even when the financial incentives are temporarily down.
But having a brilliant purpose on a PDF document is one thing. How does that translate into the mechanics of the real world?
You mean, how do we measure it?
Yeah. How do we measure if that purpose is actually being fulfilled day to day?
Well, we look at utility metrics. Projects that live entirely in the realm of promises and promotional language, they build curiosity, sure, but they don't build market conviction.
They don't build trust.
No. You have to look at the actual integration. Are established businesses settling cross-border remittances on this network? Are developers spending their weekends actually building decentralized applications on top of it?
Right.
Are there active wallet addresses that are moving real data rather than just bots wash trading on an exchange to simulate fake volume?
It makes me think of evaluating a commercial neighborhood. You walk down the street and see this massive empty restaurant. It has a $1 million billboard promising the greatest dining experience in the city, but it's empty. Then, 2 doors down, there is a quiet, unassuming diner. No neon signs. But you look through the window, and every single table is packed with locals. You know immediately which one is better. The locals are the proof of value.
That is a perfect analogy. The physical presence of those locals is the exact equivalent to network nodes and active users.
Yeah.
Because you really have to remember, decentralized networks are not just automated software.
They aren't.
No, they are living social systems. The community is what physically keeps the network alive.
Let's dig into that mechanism for a second. Because when regular retail investors hear the word community in crypto, they usually picture, well,
Thousands of people on a forum shouting.
yes, shouting at each other with rocket emojis, constantly hyping up the asset to the moon.
And that is the exact opposite of the structural community we were talking about.
Right.
An informed structural community is made up of node operators. These are individuals and organizations globally, running the software on their own hardware, verifying the ledger, and enforcing the rules of the network.
They are doing the actual heavy lifting.
Exactly. If there is a bug Or say an attack on the network, it is this community of developers and node operators who coordinate to patch the vulnerability and reject malicious transactions.
So the loud crowd shouting about getting rich quick, that's just noise.
Just noise.
The actual community is the decentralized group of engineers and operators quietly keeping the servers running when the power fluctuates.
Yes. When a community is solely focused on price action, it is usually masking pure speculation. A resilient community discusses technical upgrades, they debate the merits of different scaling solutions, and they focus on the security of the protocol.
But wait, how do you even verify what developers are doing behind closed doors? I mean, if the whole point of this technology is that it is trustless and decentralized, I can't exactly walk into their corporate headquarters and audit their workflow. So how is transparency actually achieved in this environment?
Through open source development and public ledgers.
Yeah.
You see, when we talk about transparency in traditional finance, we usually mean quarterly earnings reports or polished press releases.
Which can be spun by a PR team.
Exactly. But in a decentralized network, transparency means a public GitHub repository.
So literally anyone can look at the code.
Anyone in the world. You can log on right now and see exactly what line of code a specific developer changed yesterday at 2 p.m.
Wow.
You can see the debates between engineers about how to implement a new feature. There are no closed doors. If a core developer leaves, the project doesn't collapse because the codebase is public property.
Another team can seamlessly pick up the work.
Precisely.
That shifts the dynamic entirely. It makes me think of a busy, crowded traffic intersection in a major city.
Okay, I'm following.
You don't know the other drivers. You certainly don't inherently trust the person in the massive truck next to you not to hit you.
Definitely not.
But you trust the system of traffic lights. You trust the painted lines and the shared rules of the road that everyone is visibly bound by.
Yes.
If someone runs a red light, it is immediately visible to everyone at the intersection. The public ledger is the traffic light.
That is a phenomenal way to visualize it. You are not trusting the participants themselves. You are trusting the visible, mathematically enforced rules of the intersection.
Right.
And when those rules are transparent, everyday users don't have to rely on insider language or blind faith. They can look at the on-chain data and see that, despite market volatility, the network is executing contracts exactly as programmed.
Which brings us to a massive psychological trap.
Oh, the shortcuts.
Yeah.
Yeah.
Because real structural reputation takes years to build through all these mechanisms. The open source commits, the node operations, surviving the market crashes. A lot of new projects try to take shortcuts, don't they?
They try to manufacture the illusion of credibility.
And they are incredibly effective at it.
Unfortunately, yes. The most common shortcut is branding. We see slick logos, aggressive viral marketing, stadium sponsorships.
And celebrity endorsements.
Well, especially those.
Because our brains are biologically wired to confuse visibility with reliability. If an A-list actor is talking about a digital asset during a major sporting event, the immediate subconscious assumption is, well, the underlying technology must be structurally sound.
It is the ultimate illusion.
Yeah.
Visibility simply brings you to the front door. A loud, well-funded marketing department has absolutely zero correlation with the security of the cryptographic hatching algorithm or the decentralization of the nodes.
Zero correlation. And then there's the most dangerous illusion of all, which retail investors fall for constantly.
The price chart.
The price chart. It is so easy to open an app, see a green line shooting upward by 50% in a single day, and mistakenly assume that a rising price means the asset is successfully achieving its purpose.
Decoupling price action from network credibility is probably the single most important skill an investor can develop in this space.
So, what does this all mean for the everyday person looking at these charts?
It means realizing that price reflects the aggregate mood of the market in a specific millisecond. It captures surges in macroeconomic liquidity, algorithmic trading, fear of missing out, and pure, unadulterated speculation.
So a highly respected, deeply utilized protocol can go through a 6-month period where its price is just bleeding out.
It happens routinely. The broader economic conditions might tighten, interest rates might rise, and institutional capital might pull back. That causes the asset's price to drop significantly.
Right.
But if you look at the underlying metrics during that exact same period, the developer commits might be hitting all-time highs. The daily active users might be growing. The market conviction in the utility is totally intact, even while the price is down.
That's fascinating. And conversely, you could have a protocol with literally no utility, a centralized group of insiders controlling the supply, zero developer activity.
But it spikes massively in price because of a viral social media trend.
Exactly. It has peak price, but zero fundamental credibility.
Which is why relying on a green candle on a chart to determine safety is a recipe for disaster.
Absolute disaster.
When you strip away the stadium ads and you strip away the daily price fluctuations, you are left with the raw reality of human psychology.
We have to make decisions in a highly complex, uncertain environment.
And when faced with uncertainty, we look for mental anchors.
Familiarity bias.
Yes. We lean toward names we have heard repeatedly over the years in serious contexts. We trust certain networks simply because they have been mentioned in financial reports or discussed by technologists for a decade.
It is a perfectly healthy defense mechanism, really.
If we connect this to the bigger picture, the decentralized ecosystem is inherently chaotic.
Very chaotic.
Relying on established infrastructure protocols feels stable, understandable, and frankly less likely to result in total embarrassment.
Nobody wants to explain to their family that they lost their savings on a yield farming protocol named after a cartoon fruit.
No, they don't.
Especially one that suffered a smart contract exploit 2 days after it launched.
Exactly. There is psychological safety and proven resilience. But this dynamic also means that genuinely innovative new projects have a massive hill to climb.
Because they are starting from zero.
As they should be. A new network hasn't survived a liquidity crisis.
Right.
It hasn't proven that its node operators will stick around when the block rewards decrease. Because of that lack of history, new protocols require intensive research and curiosity from users.
But they absolutely do not command automatic market conviction.
Never automatic.
That feels like the hallmark of a maturing market, doesn't it?
It really does.
We are watching the ecosystem split in real time between serious foundational infrastructure that operates like digital public utilities.
And the noisy, speculative novelty tokens.
Exactly. We are finally applying the same rigorous standards of physical infrastructure to digital infrastructure.
It's a bad time.
Let's pull all of this together for you, the listener. To navigate this space effectively, to get beyond the hype, you do not need to be a cryptographer.
Not at all.
You do not need to read the raw hexadecimal code of a smart contract. You just need to slow down and ask grounded, mechanical questions.
Like, has this network been stress-tested by a severe market downturn?
Yes. Is its operational purpose clear, or is it just shifting goalposts to chase the latest trend?
Are developers actively patching and upgrading the public code?
And perhaps most importantly, if the price stayed completely flat for the next 5 years, would anyone actually still use it?
If the answer to that last question is no, you are looking at a speculative asset, not a trusted network.
A brilliant litmus test.
But, I want to leave everyone with one final layer to this puzzle.
Okay, let's hear it.
We have established today that credibility is painstakingly built over years, anchored to a very specific, reliable purpose.
Right. It is the heavy knife doing its job every single day.
But what happens if a protocol with massive, decade-long market conviction suddenly decides to undergo a hard fork and completely pivot its mission? Imagine a network universally trusted as a slow, secure store of value suddenly alters its consensus mechanism to become a high-speed computational layer.
That is a fascinating scenario.
Does the historical credibility automatically transfer over to the new mission? Or, because the fundamental rules of the intersection have changed, does the clock reset entirely back to zero?
It is the ultimate question of identity, isn't it? If that 20-year-old tea stall in your neighborhood suddenly clears out its kitchen and starts selling motorcycle parts,
Exactly.
do you still trust them to fix your engine just because they made great chai?
Probably not.
Mm-hmm.
Market conviction is inextricably tied to the promise you originally made.
Something for everyone to carefully consider the next time a major network announces a radical upgrade.
Absolutely.
That gives us plenty to process. Thank you so much for joining us on this deep dive.
It was a pleasure.
If exploring the actual mechanics behind the noise helped you view the digital landscape a little more clearly today, please share this with someone who is trying to figure out how decentralized systems actually function in the real world.
Spread the knowledge.
Keep researching, stay curious, and we will catch you on the next one.